Look at this chart. This is the S&P 500, the green line is the bond market's fear index inverted, so when it falls, stress is rising. For the past year, they moved in lockstep. Now a massive gap has opened. Stocks are hitting all-time high, the bond market is not following that move. I used to trade this back in my hedge fund days. When you see a gap like this, you wait patiently, you brace for impact, wait for correction and protect your capital. The last time this happened, stocks coughed down to bonds pretty fast. There is a number I need you to remember, $800 billion. We will get to it in about few minutes and it will explain every anomaly you're seeing right now and why the stock market refuses to crash. We're at the Shiller CAPE ratio of 4:1, the second highest valuation in 155 years. The only time it was higher was the dot-com bubble. To understand why the bond market is freaking out, you have to follow the money, and right now the money is hiding in plain sight. Pause the video right now and look at the exact minute this candle forms. Just before the latest Iran deal rumor, someone placed 920 million short on crude oil. 3 hours later, Trump tweets, "Oil nosedive to $89, the shorts cover and profits are taken." And this is no longer just a conspiracy theory. ABC News is now reporting that the DOJ, the Department of Justice, is actively investigating a series of suspicious timed oil trades. Trades placed directly ahead of the major announcements by President Trump about the war with Iran. The federal government is looking into whether someone had advanced knowledge of market-moving geopolitical events. Think about what that means for every chart in this video. Oil didn't stay down, it bounced right back to $96 because of short covering. Right now, it's still above the $75 to $80 disinflation zone we warned you about last month. That is structural, and remember, the shorts never take delivery, they just flip contracts. The underlying commodity is still tighter. And it is not just oil. The Bloomberg Commodity Index just smashed through the multi-year highs. Wheat, copper, natural gas, everything is trending up. This is the Fed's worst nightmare. If you want to stay ahead of the institutions instead of buying their backs, and if you want to learn directly from me, a former hedge fund trader, subscribe now so you don't miss my next call. Now I want to show you something interesting. Look at this treasury yield chart. Every single time the 10-year yield tries to break above 4.5%, someone tweets about Iran, about the deal, about peace, and the yield gets swapped back down. So ask yourself, why is the 4.5% so critical that it has to be managed? Because 4.5% is the tipping point where the AI debt bubble implodes. This is Morgan Stanley's data. The top 5 AI hyperscalers, Amazon, Google, Meta, Microsoft, Oracle, are projected to spend, remember that number? $800 billion in 2026 and over $1.1 trillion in 2027. That is triple what they spent just 2 years ago. And here is the terrifying part no one is talking about. I want you to screenshot this next slide, send it to your financial advisor, see if they even know this is happening. This is Meta. They generated $54 billion in free cash flow in 2024. By 2026, that number is projected to be negative, minus $3 billion. Here is Amazon. Their free cash flow is collapsing from $53 billion to near zero. Yes, these companies report massive profits, but their actual cash flow is getting obliterated by AI spending. If you are spending more cash than you make, where does that money come from? You borrow it. This is very important. It is from the Bank for International Settlements, the central bank of central banks. They're calling this shadow borrowing, obligations that act like debt but live off the balance sheet. Morgan Stanley's credit desk said the quiet part out loud. Credit markets are financing the AI buildout. If credit markets freeze, the AI revolution stops. Now put the pieces together. Oil and commodities are rising, inflation is sticky, the Fed cannot cut rates right now. Japan just blew $34.5 billion in April defending the yen, likely funded by selling US treasuries. All of this pushes the 10-year yield back toward that 4.5% red line, and when you're borrowing $800 billion, a few basis points of extra interest can bankrupt a project. So the yield curve is steepening, but it is the bad kind of steepening, driven by supply glut and inflation panic. And here is the part that everyone misses about inflation. Inflation is not the final destination, it is the setup. When prices rise this fast for this long, consumers stop spending, they have to. The rent is up, the groceries bill is up, the gas is up. At some point, the math stops working and people pull back. That is called demand destruction. And demand destruction, if it comes fast enough, does not lead to soft growth. It leads to deflation. Prices start falling, corporate revenues contract, and now every company that borrowed hundreds of billions to build out AI infrastructure is sitting on a mountain of debt with a shrinking top line to service it. Inflation kills you on the way up, deflation kills you on the way down. And right now we are getting the worst possible setup for both. That is why the movie index bond volatility is elevated. The bond market knows this debt structure is fragile and stocks are ignoring it. Now I have to give you the bull case because that is what we do in this channel. We look at both sides. The top 10 Nasdaq stocks today have averaged a 784% return. That's better than the dot-com bubble peak, and unlike 1999, these companies combined for over $200 billion in net income. Yes, they're monster businesses. If the Fed pulls a miracle and credit markets digest this debt supply without hiccuping, then 12% earnings growth might actually justify a sure price-to-earnings ratio of 41. It happened from 97 to 2000. But you have to look under the hood. I mentioned the dot-com bubble. Let me show you exactly how close we are. This is the Philly Semiconductor Index. The black line is the price, the pink line is the 200-day moving average, the long-term mean. The two red circles are the only two times in 25 years the price has extended this far above its mean. The first red circle is the year 2000. What happened next? Well, everybody knows that. The second red circle is today. Semiconductor stocks are now trading above their 200-day moving average by the largest margin since the dot-com bubble. The mean always wins, always. Now let me show you the actual S&P 500 futures chart and what the structure is telling us. This technique is called measured moves. The logic is simple. When a market breaks out of a consolidation range, it tends to travel a destination equal to the size of that range. The large gray rectangles on this chart map the bigger swings, the major structural moves of the last 2 years. The smaller dark red rectangle is the more recent one. It marks the size of the break from the tariff crash low and projects where that move runs out of fuel. Right now the S&P 500 is trading directly inside the upper portion of that red box. Price is approaching the measured move zone, and this is not a guarantee but a warning, the kind of level where professional sellers start showing up. And the RSI at the bottom of that chart 75. That is deep in overbought territory. Territory that on every prior occasion on this chart preceded a mean reversion. The chart is telling you the move up is running on fumes. Stock correlation just hit levels not seen since 2018 Vomageddon. Individual stocks are trading wildly on their own. The surface index looks calm, but underneath it is a war zone. Look at the volatility spread between Europe and the US. It is the widest since the start of the Ukraine war. Europe is pricing in the geopolitical reality. Wall Street is plugging its ears. And then there is this. Look at this chart going back to 2017. For 9 years, the average split between calls and puts on S&P 500 options held in a narrowed band. Yesterday, almost 60% of every single S&P option traded was a call. 60%, near the highest in 9 years of data. Now look at the dollar notional behind those calls. The S&P 500 traded $2.6 trillion in call notional yesterday. That is an all-time high. It is not even close. So if you go back to 1999, this has never happened before. The entire market is now one giant gamma squeeze. When market makers sell you all those calls, they have to buy the underlying stock to hedge. So every buyer of a call forces a professional trader to push the market higher. This is a mechanical bit, not fundamentals, not earnings, not the economy. This is pure mechanics buying the index. And when the squeeze exhausts itself, because every squeeze does, the mechanical bit disappears overnight. And the VIX always fills its gaps. The downward gap we called last time is filled. It is making higher lows, mirroring 2019. In 2019, I stayed out of the markets while most people were buying, so we all know what followed the next year. And right now, the pressure is compressing like a spring. So how does this play out and what do we do about it? So next week we will get the CPI and the PPI. If those inflation prints come in hot, the Fed is trapped. The 10-year yield will assault 4.5% again, and if it breaks and holds above 4.5%, servicing that $800 billion in AI debt becomes lethal. The credit markets will choke, and when credit chokes, the gamma squeeze can hold. That $2.6 trillion in call positioning unwinds, and it will drag equities down by the throat to close that gap we looked in the first minute of that video. So watch the 10-year, watch commodities, watch the options flow, protect your downside. See you in the next one.